Welcome to the show. I spoke to a friend recently who invested in a restaurant business. She was absolutely sold on the business plan, which included a world-renowned chef to run the operation. Unfortunately, she was not informed and did not learn that the chef had very little skin in the game. At some point, after a difference of opinion between the chef and the sponsor, the chef decided to leave, making the sponsor, who had no experience in running a restaurant, take over completely. The deal eventually faltered, and my friend lost her entire investment. And she stated to me that she would have not invested in the deal if it weren't for the IR representative who communicated a perfect opportunity to her and answered every question the way she wanted to hear it. So the question really is, how do we spot this type of sales pitch? And what questions do we ask ourselves and ask the IR team and the sponsor to prevent this from happening to us? And to answer this question and many others, today we are happy to have Chris Parrinello, who is the Director of Investor Relations for Viking Capital Investments. In this role, Chris leads the investor relations team and is involved in overall investment strategy. Previously, Chris had roles as the Director of Capital Markets, PIA Residential in Miami, and as the Managing Director of California Golden Fund in Los Angeles. In these roles, he had managed the capital raising efforts of over $300 million in private equity funds from family offices, RIAs, high net worth individuals, and foreign investors. Welcome, Chris.
Thanks, Ravi. Thanks for having me.
Absolutely happy to have you. Let's get started with you telling us a bit about your background, how you got in investor relations. But then I also want you to add something that many of us do not know is the fact that you speak fluent Chinese. And I want to understand how you were able to obtain the skill.
Yeah, so I can actually start there. I studied Chinese in college, and I really thought that what I was going to be working on for my career was import-export work, kind of what my dad did working for the DoD. So after living in China for several years, I just, on a chance opportunity, started working for a high net worth investor that got me into real estate. And after working in real estate for a little while for a Chinese real estate firm, I really grew a passion for real estate. So my first role in California when I moved back stateside was helping Chinese investors invest into hotel development projects to get a green card and a small return. This really prepared me well because you have an investor base that doesn't really know a lot about the investment, doesn't really know about the United States and real estate. They want to invest primarily to get a green card and not to get a return. But at the end of the day, they don't want to lose their money. So the big hurdle was always simplifying a really complicated investment strategy for someone that doesn't really speak the language, doesn't really know the culture, and helping them understand how you're protecting their capital. I think that foundation really served me well for Viking and for PIA and all my other endeavors, because at the end of the day, the thing that nobody really talks about when they're an investment salesperson is risk. And I've learned that it's the most important thing that you should talk about.
That's great. Excellent. And that sort of gets us into the next part of this conversation and the story that I mentioned at the beginning. So I guess the first part of this is, how do you gain the trust of the investor, and how does the investor get to know you?
Right. So I think the big thing is when you have your first discovery call with someone, which is really just a name for the first point of contact where somebody's made it in through your marketing or they've reached out because they've been referred to you. It's trying to understand what's their motivation, first and foremost. Are they just trying to get a return? In the case of the Chinese investors, like, they weren't really focused on the return. They wanted the green card. So why are they investing? And then you really want to try to assess where they're at in their investment journey, how sophisticated they are. You would have a different conversation with a small family office, their investment committee, versus a physician who's investing in a real estate deal for the first time. So once you kind of piece all of this together, you as the professional and the IR person can kind of tailor an educational type approach to help prepare them to make the best decision for them while analyzing risk and opportunity at the same time.
Great. Now let's jump to the flip side of that, give us an example of a sponsor or team member that misled you, whether this is something that directly happened to you or something that you've seen in outside companies.
Yeah, I would say going back to my first role with California Golden Fund, unfortunately for folks that know the EB5 industry, there were a lot of bad actors in that space. I was fortunate to work for some really great folks that were very transparent, but there's folks that leveraged their entire net worth to get US citizenship, and there was just fraud in the industry. It wasn't highly regulated. So you have people, and it usually comes down to people not being transparent. They're not telling you that there could be a risk. They're charging really high fees up front. They're not really aligned with the investor on the back end of the deal. Those are really where you start running into problems. And then on top of that, you want to make sure that it's hard to trust somebody to explain to you that the deal works if they don't actually know how the deal works themselves. I think that's a big thing that you sometimes see in investment sales, because a lot of times you have someone that's really a salesperson and isn't really an investment professional.
Got it. So in this example, people didn't really understand the investment. They had other goals in getting green cards, and not necessarily, they obviously were interested in preserving their capital, but that wasn't their primary goal. And an industry completely fraught with fraud, and that just made it easy to mislead these folks.
It was a huge problem, and it caused the program to shut down. It just recently reopened in the last year or so because of the institutional oversight that the government decided that they needed to institute in order for it to be a successful program again.
Interesting. And from my personal experience, I invest in other sponsors, not only with Viking Capital, but with several others. And I had a high-level call with one of the sponsors, and I asked them specifically about certain aspects of a deal, and specifically how much money that they were holding in their reserve accounts. And I didn't get a clear answer. It was he sort of beat around the bush and didn't really give me the answer that I wanted to hear. And coming from the space, I knew exactly what was going on, and I could look at the finances and understand how they were able to project the returns that they were and give the cash flow that they said they were giving. And I really wanted to hear from him that this is what was happening, but I didn't. And that really was a cause for concern for me, because obviously this investor relations person wasn't being as truthful to me about all the aspects and all the risks that were being taken on this particular deal. So that was my personal experience of having someone not necessarily tell me a false information or lie, but just withholding information that he probably shouldn't have. Anything else that you have, any other experiences that you have had?
Not specific experiences. I'd say seeing in the industry and folks that I talk to on a daily basis, a lot of times I do notice that after spending 30, 45 minutes going with someone, going through the underwriting, really diving into a deal, I feel like every day somebody tells me like, oh, I finally understand how these deals work. No one's taken the time to go over this information. And I think that's probably, the biggest problem, is that a lot of people are asking questions because they know they have to do due diligence, but they don't really know which questions to ask or what answers they're looking for. They're just really going off like a checklist. So I think that one of the things that I love that we do is that we prepare people to even make our lives harder. We want people to ask us hard questions, to dig into the underwriting, to understand the deals, because we know at the end of the day that things happen, and there's going to be days where a Viking deal doesn't perform as well as we thought it did. And you want to be able to go back to your investor and be like, remember that conversation we had where, we talked about these potential risks? Like, this is what we're going through right now. And then they feel included and they're reasonable. And they said, no, this totally makes sense. We want you to protect the overall value of the property. So I think that it's uncommon in the industry. A lot of people are very focused on making the sale and being the best salesman they can be. But in this particular environment, you're really a steward for these folks to create wealth.
Yes, I love how you put that. And I'll give you an example of that as well. I just, in fact, came back from lunch with somebody that I respect very highly who is in the retail space, not multifamily and commercial retail. So he had several deals that went south. And when a commercial retail deal goes south, that means one of your credit tenants, probably the biggest one in your strip, has left and the whole place goes under. He had two experiences like that where the entire property went under. Every investor lost every penny that they had in the deal, but he still has people clamoring to invest with him. And the reason is because he was very upfront and honest about the risks to begin with. He said that, hey, look, there is a chance that you're going to lose every penny on this investment if this, and this happened. And unfortunately, in his 40-year career, he has experienced those things a couple of times. It always happens. But that honesty really carried through. And even though these people lost a considerable amount of money, they made a lot of money elsewhere. And once you trust a sponsor and leave them, it'll all work out at the end, as long as you know that they're doing a very good job and he's a phenomenal operator. And that's what happened. He did very well in the rest of their deals and they're very happy to continue to invest with him.
Yeah, honesty and transparency really does go a long way.
All right. So let's jump to the next question for you. What question should an investor ask to ensure that they are understanding the risks as well as the benefits of the deal, not just the benefits?
Yeah, I would say that in our asset class, and you're talking about institutional multifamily, I think the biggest questions to ask revolve around the debt. The ultimate risk in any of these syndicated type deals is maybe the sponsor's using a predatory lender. They couldn't get an agency loan because they were DSCR constrained or something like that. If you don't ask questions about the debt, then you might not know who the lender is or what the interest rate is. They're probably not marketing it if it's not attractive. So ultimately, you don't want to get into a situation where the sponsor is worried on a month-to-month basis if they can pay their debt service. So that's usually when I'm coaching people and showing them, walking them through our deals, I'm like, this is where our threshold is. If it's below this, it's not a bad deal. Doesn't mean that it's a bad sponsor. It's just kind of a red flag. And the other types of questions that I think, you'll typically get from sophisticated investors or family offices that live in this space are, how aggressive are the assumptions that you're making when it comes to loss to lease, rent growth? Does that area show a historical context for that rent to continue growing at that rate? Or something like the times we're in now. Rent growth has exploded, but now it's coming back down to earth. In our deals, we're not putting the rent growth we're seeing in year one at the property level. Some other sponsors might not do that. They might be plugging in exactly what it is at the property when they know that 2 years from now, it's probably going to be half of that or a third of that. And using the idea of kind of financial engineering to show the returns that they know investors want to see.
Yes, absolutely. So I think you're using a lot of technical jargon and talking about the specifics of the deal. And I think that belabors the point that as an investor, you really should do your own research as well. Don't trust everything you're hearing. You have to understand what these different aspects of the deal are and what makes sense to you. That's why we're putting out these podcasts. And that's why we have webinars. That's why other sponsors have webinars and podcasts and things like that, because it offers you the information you need to make an informed decision. And you should really pay attention to these types of things. Get books, get whatever you need to understand these investments, because it's a lot of money you're putting down. You want to make sure that the sponsors are good stewards of your capital. So that's what I would say, just make sure you do your own research. But on top of that, Chris, great point in really focusing on debt, because that's been a huge problem of late. In fact, there's another sponsor that I know who acquired great debt at the time. This was back in 2019, but as the economy progressed into what is now becoming a recession, interest rates are rising, inflation's going up, the debt is transformed because it's a variable rate and the deal is not performing well. So looking at the debt is ultimately the most important thing. What other questions should people ask, Chris?
Yeah, what I like to do, and especially when I jump on the phone with somebody and I can tell that they don't really know the right questions, They're not asking me the questions that I would ask if I were analyzing the deal. I usually at that point will try to walk them through the high level points of the deal, and I'll immediately try to schedule a call to kind of go over our underwriting with them. And it takes 45 minutes, and I would implore any investor, if you're looking at a Viking deal, to ask to go through it with me. Or if you're going with another sponsor, like ask them, say, hey, can you walk me through the underwriting? And it's 45 minutes well spent because you'll understand, the pro forma and the underwriting really break down every tiny piece of the deal down to the penny. So it's really easy once you understand how to read it to kind of look through it and to understand where the soft spots are of the deal, where things are a little bit more aggressive, less aggressive. Like when they give you a range of this to this as your return, like why is it that range? Is there a sensitivity analysis table, like something like that? Like being able to show people that, like when you finish that review, folks really tend to feel gratitude. They understand how the deals work. And that's what I would expect if I was going to invest my money with us or any other sponsor, is somebody taking the time to explain to me the mechanics of the deal.
Yeah, that's great advice. And if the sponsor that you're looking to invest with is not willing to do that, then you should really look elsewhere. It's very important for you to understand the nuances. Another thing to do is, if you're looking at investing with multiple sponsors, talk to one sponsor about the other one. Say, hey, I was thinking of investing with X, Y, and Z Capital. What do you think about them? What have you heard about them? And get their take on it. They may give you some information that you can double check with the that other sponsor. So that's another way to look at sponsors, and maybe talk to different representatives in that company and make sure the story is consistent. That's something else you can also do.
I completely agree. And a lot of investors sometimes are scared, tell me or someone on my team that they're looking at another sponsor's deal. But I always tell them, like, don't feel that way. Like, we all invest, and diversification is a great tool to use. So if there's ever a way that we can help evaluate another deal for you or help you make the right choice on whether you're going to place your capital with another sponsor or not, we've made referrals to other companies make referrals to us. It really is a small world out there, and people's track records are very well known by all the sponsors in the space.
Yes, absolutely. And if you do have a question about another person's deal, as Chris mentioned, reach out to us. If you have a question about different asset classes you want to invest in, reach out to us. Happy to answer any and all of those questions. Okay, so moving on, explain to us your approach to getting to know an investor and getting to know what they look for, because you mentioned earlier that that's important to you.
Yeah, no, I think, the biggest thing is trying to figure out the sophistication level when it comes to, the deals. Like some folks that invest, it could be the very first investment they make. Some of them have done a handful of deals. So you really want to ask questions that are going to help give you insight into where they are in their investment journey. So it might be, how many deals as an LP have you done? Have you ever done a small multifamily deal on your own as the GP? How much money have you placed, and what are your expectations for the money that you've placed? Like all of these things will give somebody that lives in this space an idea of what you're looking for, what kind of returns you're looking for. And at the end of the day, an investor relations person, whether it's me or any of the people in the industry, you're always trying to assess if you're a good fit for the investor and if the investor is a good fit for the product that you're promoting.
Have you ever been in a situation where you had to turn away an investor?
Absolutely. Yeah. So an easy one is when you're doing a 506c offering and they're not accredited and they don't really know the accreditation rules or why the accreditation rules exist. So helping educate what it takes to invest in something that's exclusively for accredited investors is a big one. Sometimes I've had investors that they're really focused on the cash flow, but they're not really looking at the back end of the deal, and they feel like the cash flow is most important. I try to dig in. I'm like, why are you so focused on the cash flow? Some folks are borrowing money to invest in deals, and they think that if there's a spread, that they should be doing that. Like, I always caution people not to do that. It's like, things can happen. We might think we're going to give you 7%. And if you're borrowing money at 5%, counting on that 2% spread, if something goes wrong, like you could be negatively leveraged. So there's quite a few reasons why you would advise an investor that you might not be a good fit, but they usually revolve around cash flow or availability and their availability to be able to actually invest.
Yeah. And I think that is a very important concept. If we as a sponsor feel that you as an investor isn't a good fit for us, we should not accept that money because, our expectations are not aligned. And I've experienced that as well as the COO and founding partner here. There are some investors that expected X, Y, and Z, and we could only give them ABC, and they didn't appreciate it. And, it just became a very difficult, contentious type experience for them, and it became difficult for us. So we really want to align with our investors. And if it doesn't work for us, if it doesn't work for you guys, then you should look elsewhere. And from our perspective, we're happy to give you other references. And we always want to make sure that we are hitting your expectations as a company. Next question, Chris. What question should an investor be prepared to ask you? You mentioned some of these earlier, but anything else that you can think of?
Yeah, I think one thing that gets overlooked sometime is the track record. People will say, do you have a track record? And I think it needs to be a little bit more detailed. It's how many deals have you exited? What were the returns on those deals? If there was a deal that it's an outlier, why was it an outlier? What kind of things went wrong in the deal? And then one thing that I always like to tell investors, and I tell them they should ask when they're asking folks like me questions about track record is trying to find out what, as a sponsor, they've learned over the deals that they've done. What has gone right? What has gone wrong? What didn't you expect to go wrong? These are things that can't really be made up on the fly. And I think most sponsors would be pretty honest and be like, didn't really think about this. And we learned from it. We're not going to do that again. I'm sure you have things over Viking's history that you've learned. And I think investors should hear that stuff.
Yeah. And, we have a deal that went sideways that we've disposed of in the past couple of years. And I actually wear it as almost a badge of honor, right? I mean, I'm proud to say that we didn't lose $1 of investors' money. We were able to give them, a reasonable return. It didn't hit our pro forma. That's okay. These things happen. And I want to share that information with investors because I want them to know, hey, look, this is what went wrong with this property, and we were able to overcome that. And any sponsor that you invest with at some point is going to have a deal that's not going to hit their expectations in pro forma analysis. If every deal is hit, then you really, it should raise a flag for you and make you look deeper into that. Because maybe it's true. Maybe they're just that good. Or maybe they have a ton of experience and they shifted into another company that's relatively new and their new company is like just killing it. And that may be the case. And obviously there's nothing wrong with that. It's great. But if you see that, just take a second look because they may not be telling you the full truth. And what I've seen over the many years that I've been doing this and talking to people that I respect highly, everyone has had a deal that went sideways, that underperformed, and they had to work through it in some way or the other.
Absolutely. I mean, at the end of the day, a lot of these deals, investing in these types of deals and managing them from an asset level isn't easy work. And you're having to prognosticate out 5 years. Everything's not going to go according to plan. And a lot of things happen behind the scenes, and sponsors have to really dig deep to bring all of these deals to fruition. But really experienced sponsors will be willing to share some of those battle stories with you because they know, like you said, it's kind of like a badge of honor to be able to make it through multiple real estate cycles, the really easy times to operate and the really hard times.
Yes, absolutely. Okay, let me ask you this. What should an investor expect in terms of a superior investor experience? So what strategies do you use to provide that experience?
So I think the biggest one is availability. It's one of the things that kind of gets lost as companies grow into larger and larger companies with a large amount of investors. But at least for the way Viking's structured and the way that I've handled myself at all the other places I've worked, people have my cell phone number, and if they want to call me or they have a concern about something, they can shoot me a text or call me anytime. I think that's the biggest thing that I've heard of complaints is, oh, I'm working with XYZ sponsor and I've been trying to reach them and I had a problem with my K1 or I had a problem with something and it's taken weeks for them to get back to me. And that's something that if you want to really provide a white glove experience, it's availability. Other than that, I think the big things are education. I think Viking does this really well. With you and Vic both being physicians, we have a lot of physician investors that don't have time to study structured finance for 10 hours a day. So being able to kind of take really important topics and things that are important in the industry and provide them that in the form of a newsletter or a blog or some kind of webinar, those types of introductions to other third parties in the space, whether it's a CPA person or whether it's somebody that's going to help them unlock value in their IRA, those types of things investors really, really appreciate because a lot of them, are busy professionals that don't have the time to source this information on their own and then feel comfortable that even if they do find it on their own, that it's the right information and it's the things that they should be committing to memory.
Yes. Those are great answers. I want to stack on that. Communicate. That's super important. I've had investments that have gone very well. In fact, much better than I expected, but the sponsor didn't communicate well and I did not invest with them again because the communication was so poor. I've had investments that didn't go very well, but I got such great communication that I trusted them and I invested with them again. So that is really key in an investor's experience is having that, getting that communication, having the ability to communicate with someone, as Chris mentioned, at just a quick text or a quick call, because otherwise it becomes uncomfortable for people to have their money sitting with someone that they just can't communicate with and have no idea what's happening with. And let me stack on that. Chris, what is the key to forming lasting relationships with your investors?
I would say, definitely the biggest one is creating value. Communication, like you said, is huge. Because investors don't like bothering you. They want everything to go right and they want to get their returns. And for the most part, if that's happening, they're not going to be hounding you for a lot of things. It's more uncomfortable, I think, for them to have to call and try and figure out why something isn't right than you just getting out in front of it and letting them know, oh, it's accountability too. If we do make a mistake or I make a mistake or forget to call someone back, apologizing and then making sure it doesn't happen again. People are human. They know that not everything's always going to be perfect. Outside of that, if you're creating value for people, you're being transparent and you're giving them opportunities to build their wealth, you'll have the opportunity as an IR professional to make a ton of friends in the industry.
Tell me some key things that you study about a deal and how you can best explain those to an investor.
Yeah. So I think that one thing that we went over kind of the pro forma and the assumptions and all that kind of stuff, but one thing that gets into the marketing materials, but people I think sometimes don't understand when they get on a call with me is how we're evaluating the areas that we're investing in. So people might see a graphic that says the household income, but they don't really understand why we're choosing this submarket in Atlanta or this area in Texas or why we think it's in the path of progress. And a lot of these, go to in-depth research on certain areas and figuring out maybe not what's happening today, but what is the potential for that area in the next 5 to 10 years. I think that's one of the biggest things that gets missed.
And another question, what does your preparation process look like when you get a new deal?
What I really love about the way that we do things here at Viking is the investment committee. Every executive in the company has their own unique outlook on what makes a good deal. So for me, as the director of investor relations, I have the power of investor insight. I know what people want. I'm talking to people every day. I know what returns they're looking for. I know what areas they think are hot. But maybe Matt in asset management knows on the property level how deals are actually doing. And then Judah in acquisitions sees thousands of deals every year. He knows what the national trends are in all of the deals. So when we all sit down and look at a deal that we're maybe going in best and final on or hoping to win, being able for all of us to kind of poke holes in the investment thesis and say, can we pressure test this deal so much from all of our different angles and it survive? I think that's always the first step. Once that happens and it makes it through everybody's objections, then you know you have a deal that pencils well, that has legs, that really is a good opportunity. And at that point, it's how do we best disseminate all this information and provide it in a way to investors feel the same way we do about this deal. And that's, through webinars, through one-pagers. One thing that we do as a team is we'll call all of our current investors and give them kind of a heads up that we have a deal coming in. And if they want to hear more about it, we give them a week head start on any of the marketing that goes out publicly. And folks love that because a lot of times deals oversubscribe very quickly and people need time to see how much money they can invest and see if it's a good fit for them. So being able to do that and to give people access a little bit earlier is one way to really keep investors happy.
Awesome, Chris. That was a very solid, comprehensive overview of what to expect from the IR department of any given sponsor, what to consider when you're looking at a deal, and how you can spot red flags, maybe some mistruths or other types of potentially deceitful type comments that you're hearing from folks. Gave some tips on how to figure that out. Anything else you want to add to the conversation, Chris, before we end?
No, I don't think so. I appreciate you having me and giving me the platform to reach out to all of our investors. Any of the folks out there that want to just jump on a call and chat through what Viking has going on, feel free to contact me. My phone number and email address are readily available on our website and other areas.
Excellent. Thank you so much, Chris.
Thank you.